Have you ever wondered how a tiny startup with no money becomes a billion-dollar company? One answer: venture capital. But what even is venture capital, and how does it work? Imagine you have a big idea for a new app. It could change the world, but there's a problem. You're broke. Enter the venture capitalist, or VC for short. A VC is someone or a firm that gives you money to grow your company in exchange for ownership. So instead of going to a bank and getting a loan, you go to a VC, and they give you cash, but they now own a piece of your company. It's called equity. You own 100% of your startup. A VC gives you $1 million for 20% equity, no repayments, just ownership. If your startup fails, they lose money. But if it succeeds, that 20% could be worth millions. VCs invest in many startups knowing most fail, but one big win, a unicorn, can make up for all the losses. Here's how it typically works. You start a company, called a startup. You raise a seed round, early money from angels or small funds. If you show growth, you raise a Series A, then B, C, and beyond, each time selling more shares to get more fuel for growth. Eventually, the company goes public, IPO, or gets acquired, and the VCs cash out their shares. VCs don't just bring money, they often help with strategy, hiring, intros, and credibility. But they also expect growth, fast growth. So is venture capital for everyone? Not really. It works best if your business can scale big and fast, like tech, software, or platforms. But if you're building a small local business, you probably don't need VCs. You need loyal customers. Here's the bottom line. Venture capital is about high risk, high reward. It's rocket fuel for startups, but once you take it, you're on a fast ride. So next time you hear that a company raised $10 million in VC, you'll know they didn't just get money. They sold part of their company for a shot at the big time. If you learned something new today, drop a bag in the comments and subscribe for